Let's now shift our focus to corporate banking. Corporate banking services are for those clients whose needs are even more complex than in commercial banking. Corporate banking clients still include mid-sized companies, but these are companies that are growing through mergers and acquisitions, and some are perhaps looking to become publicly traded. Other corporate banking clients include large domestic and multinational corporations, financial and other institutions, and governments. Corporate banking services are largely credit-related with an advisory component, and in some ways, they act in between the commercial banking services the client will be using, such as operating accounts, trade finance, and cash management, and the other areas of the bank, such as access to the debt and equity capital markets through investment banking, which we look at in the next section of this course. Let's look at the loan products provided through corporate banking. Beyond the traditional loan products already mentioned, corporate banking offers access to other, more sophisticated loan finance products. They'll have similar characteristics to the other loan types, however, they're structured differently to meet the financing needs of the company. Let's talk through several different finance structures that will help companies as their financial needs become more complex. Syndicated loans, bridge finance, project finance, and acquisition finance. Let's start with syndicated loans. A syndicated loan is a credit facility provided by multiple lenders to a single borrower. It's a financing solution for large, complex transactions where a client requires access to capital and financial services beyond the capacity of one individual bank, or where the total loan amount exceeds the approved lending limits for a bank. In either of these cases, a syndicated loan is structured and arranged by one or several banks. These banks are referred to as arrangers. The syndicated loan is administered by one bank with an administrative agent capability and acts as the lead for the lending group. Virtually any type of loan can be syndicated, and you're now familiar with these different types: term loans and revolving lines of credit. Also, standby facilities. Standby facilities are also lines of credit, but they are essentially for extraordinary circumstances only and tend not to be used. Banks have many motives for offering syndicated lending. It may be the bank is looking to share credit risk, enhance the return on its asset by arranging the deal and taking a disproportionate amount of the fees from the transaction, develop other business by showing leadership in the syndicated credit market, or obtain exposure to an asset class that would otherwise be unattainable. For syndicated loans, there are a lot of fees that are charged to the borrower by the banks. Let's have a look at the most common ones. First, there's the margin, which is the interest rate on the loan and will depend on the level of credit risk taken by the banks. Next is the arrangement fee that's paid to the bank that puts together the syndicated loan. There is also an annual debt servicing fee paid called the agency fee. The other three fees relate to how the syndicated loan is structured and used. For example, a drawdown fee is charged when the borrower actually uses the facility. The fee charged can be anywhere from 0.1 to 1% of the loan proceeds. Also, when the facility is being used, for example, a revolving line of credit, then a utilization fee will also be charged, which can be 0.5% per year if the line is more than 50% drawn. Finally, a commitment or standby fee is charged annually for the undrawn portion. This fee is similar to the drawdown fee of anywhere from 0.1 to 1% of the undrawn portion. So it's clear that syndicated loans can be a good source of revenue for a bank. Next, let's have a look at another product, bridge financing. Bridge financing is a form of temporary financing intended to cover a company's short-term costs until the moment when regular long-term financing is secured. Thus, it's named as bridge financing since it's like a bridge that connects a borrower to long-term capital through short-term borrowings. A corporate bank will help to arrange the bridge financing while the organization works with an investment bank to get the debt or equity capital secured. The bank will charge a very high interest rate for bridge loans, often upwards of 20%. That's because of the higher risk of default involved. If a client isn't able to secure the long-term financing that they were counting on, they'll have to find a way to repay the short-term bridge loan, and they may not have the ability to do so. The next area that a corporate bank will help its clients secure is project finance. Project finance relates to the long-term financing of an independent capital investment, such as an infrastructure or industrial project. These projects are distinct economic units with cash flows and assets that are easily isolated. With project finance, the cash flows from the project are sufficient to cover both operating cash flows and financing cash flows. This type of financing is made up of debt and equity with a finite life, generally tied to the life of the asset. The corporate bank will consult with their client to structure the debt and equity to provide for the lowest cost of funds. We're going to focus on the different types of debt that a corporate banker will help the client arrange. As you can see, senior debt are the products that you're already familiar with. It can be revolving lines of credit or term loans. The debt is considered senior because it's held by a bank and it's often secured and therefore more likely to be paid back. Subordinated debt, on the other hand, is not secured and is therefore more of a risk. Subordinated debt is repaid after senior debt, so it has lower priority. There are several types of subordinated debt that a company can have. Let's talk about the types of debt that can be offered through a bank in the order of increasing subordination. First, a company can issue a high-yield bond. The bond is considered high yield if it's non-investment grade, and the company will therefore need to pay a higher rate of interest to attract investors to buy and hold these bonds versus traditional financing. Mezzanine debt, or mezz debt, is another type of debt instrument that a bank may offer a client. Mezzanine lending is the highest risk form of subordinated debt for a lender, but it will generate a strong return of anywhere from 10 to 15% over a secured loan that may only generate 3 to 5%. There are two types of mezz debt, warrantless and warranted. The warrant refers to the equity attached to the loan. With a warrant, the lender has the right to a return equal to the percentage of shares attached to the warrant, typically between 1 to 5% of the issuer's share value. Finally, with mezzanine debt, a borrower may pay interest by cash, like a traditional term loan, or it may add the interest to the loan balance and pay a balloon payment at the end of the term, or it may provide a warrant, which acts as equity. Often, the corporate bank will act as the conduit between the client and the investment bank to arrange these types of debt financing, and it will receive a fee for doing so. The final area to look at is acquisition finance. Acquisition finance is used for purchasing another company or for buying out the controlling interest in a company through an outright purchase of the company's shares. The structure of acquisition finance mirrors the structure of project finance. There will be senior debt, subordinated debt, and equity. The corporate banker will advise his or her client on the right product mix and will be actively involved in helping the client obtain the financing required.